Introduction to Section 14 of the CGST Act. Hello, everyone. Today, we are going to discuss a very important topic under the GST regime, Section 14 of the CGST Act. This section deals with what happens when there is a change in the tax rate for the supply of goods or services. Understanding this is crucial because tax rates can change due to government policies, and it's essential to know how to handle these changes correctly in our transactions. 10 best FAQs on Section 14 of the CGST Act. Let's dive into some common questions and examples to make this concept clearer. Horror 1. What happens if there is a change in the tax rate after an order is placed but before the goods are delivered? Imagine you place an order for goods on March 20th when the tax rate is 18%. The tax rate then changes to 28% on April 1st, but the goods are delivered on April 5th. Answer. According to Section 14, if the supply is made after the change in rate, the new rate applies. So in this case, the new tax rate of 28% will apply to the goods delivered. Sir, 2. How is the tax rate determined if the supply is made before the rate change, but the payment is received after the change? Let's say you supplied goods on March 25th at an 18% tax rate, and the payment was received on April 10th after the rate changed to 28%. Answer. The tax rate applicable at the time of supply will apply. So here, the 18% rate will be used because the supply was made before the rate change. Hadasir 3. What happens if the invoice is issued before the change in rate, but the supply is made after the change? Imagine an invoice is issued on March 28th with an 18% tax rate, but the goods are supplied on April 4th when the tax rate has changed to 28%. Answer. The tax rate prevailing at the time of supply will apply even if the invoice was issued before the change, so the 28% rate will apply in this case. Hada 4. How should businesses handle advance payments received before a rate change, but the supply is made after the change? Suppose you receive an advance payment on March 15th at an 18% tax rate, but the supply is made on April 10th after the rate changed to 28%. Answer. The tax rate applicable at the time of receipt of payment will apply to the advance. Therefore, the 18% rate will apply to the advance payment, and the balance can be taxed at 28% if the final invoice is issued after the change. 5. If both the supply and payment are made after the change in tax rate, what rate applies? Imagine goods are supplied on April 5th, and payment is received on April 10th after the tax rate changes to 28%. Answer. The new tax rate of 28% will apply since both the supply and payment are made after the rate change. 6. How should businesses update their accounting systems for rate changes? Suppose your business experiences a tax rate change on April 1st from 18% to 28%. Answer. Businesses should update their accounting systems to reflect the correct tax rate based on the timing of supply, issuance of invoices, and receipt of payments. Systems should be configured to automatically apply the new rate from the effective date of the change. 7. What if a rate change occurs during a service contract with periodic payments? Consider a service contract that spans from March to May, and the tax rate changes on April 1st. Answer. For payments received after the rate change, the new tax rate will apply. Services provided before the change will be taxed at the old rate, while services provided after the change will be taxed at the new rate. Great. How does Section 14 impact the issuance of credit notes for rate differences? Imagine a credit note is issued on April 5th for goods supplied on March 25th when the tax rate was 18%. Answer. The credit note should reflect the tax rate applicable at the time of the original supply, which is 18% in this case. 9. How should businesses handle goods in transit during a rate change? Let's say goods are shipped on March 30th at an 18% tax rate, but they are received by the customer on April 3rd after the rate changes to 28%. Answer. The tax rate applicable at the time of supply shipping date will apply. Therefore, the 18% rate will be used. 10. How should businesses manage contracts that span across the rate change date? Consider a long-term contract signed on March 1st at an 18% tax rate, but the rate changes to 28% on April 1st. Answer. Businesses should review and amend contracts to ensure compliance with the new tax rates as per Section 14. Supplies and payments made before the rate change will use the old rate, and those made after the change will use the new rate.